Imagine it's 1929. The roaring 20s are in full swing. People are dancing, the economy is booming, and the stock market seems like a one-way ticket to riches. But then, in the blink of an eye, the party stops. Black Tuesday hits, and the stock market crashes, wiping out fortunes and triggering the Great Depression, the worst economic downturn in modern history. People lost everything. Their jobs, their homes, their life savings. The banking system was in shambles, and public trust was completely shattered. This was the America that Franklin Delano Roosevelt inherited when he became president in 1933. His promise to the nation was a New Deal, a series of ambitious programs designed to rescue the country from the depths of despair. A huge part of this plan wasn't just about creating jobs, but about fixing the broken financial system to make sure a catastrophe like this could never happen again. Today, we read diving deep into three landmark pieces of legislation from this era that completely reshaped American finance: the Glass-Steagall Act, the creation of the FDIC, and the establishment of the SEC. These weren't just boring laws. They were a revolution. First, let's talk about the banks. Before the Great Depression, banking was like the Wild West. You had your regular commercial banks where people deposited their paychecks and took out loans for homes and businesses. Then you had investment banks, which were all about the high-stakes, high-risk game of the stock market. The problem was, there was no wall between them. Many commercial banks were using their customers' savings to make risky bets on Wall Street. When the market crashed, they didn't just lose their own money. They lost everyone's money. In the early 1930s, thousands of banks failed. And when a bank failed, its depositors lost every penny they had. Can you imagine the terror of seeing the doors of your bank chain shut, knowing your life savings were gone forever? This is where the Banking Act of 1933, better known as the Glass-Steagall Act, comes in. Named after its sponsors, Senator Carter Glass and Representative Henry Steagall, this law built a firewall right down the middle of the financial industry. It forced a separation between commercial banking and investment banking. Commercial banks were now forbidden from underwriting or dealing in securities, meaning they couldn't use depositors' money to gamble on the stock market. Their job was simple: take deposits and make safe loans. Investment banks, on the other hand, could continue their high-risk activities, but they had to do it with their own money and that of willing investors, not the general public's savings. This separation was designed to restore stability and safety to the everyday banking system that ordinary people relied on. But Glass-Steagall had another, arguably even more famous component. It created the Federal Deposit Insurance Corporation, or the FDIC. This was a game-changer for public confidence. Before the FDIC, if you heard a rumor your bank was in trouble, your first instinct was to run there and pull out all your cash. When everyone does this at once, it's called a bank run, and it becomes a self-fulfilling prophecy, causing even healthy banks to collapse because they don't keep all their cash in the vault. The FDIC solved this problem with a simple, powerful promise. If your bank fails, the federal government will guarantee your deposits up to a certain amount. Initially, this amount was just $2,500, but it was enough to calm the public's fears. For the first time, people knew their savings were safe, insured by the full faith and credit of the United States government. The psychological impact was immediate. The wave of bank failures slowed to a trickle. People started putting their money back into the banking system, which allowed banks to start lending again, helping to get the wheels of the economy slowly turning. That little sticker you see on the door of your bank today that says, "Member FDIC," that's a direct legacy of this New Deal era reform, a constant reminder that the system has a safety net. So the New Deal addressed the banks. But what about the stock market itself? The 1929 crash wasn't just a random event. It was fueled by rampant speculation, fraud, and a complete lack of transparency. Companies could essentially lie about their financial health to pump up their stock prices. Insiders could use non-public information to get rich at the expense of ordinary investors. There were no rules, and the market was a playground for manipulators. To clean up Wall Street, the Roosevelt administration passed two crucial pieces of legislation. The first was the Securities Act of 1933, often called the Truth in Securities Law. This act required companies that wanted to sell stocks or bonds to the public to register them with the government and provide detailed, truthful information about their business, finances, and the risks involved. For the first time, companies couldn't just make wild claims. They had to back them up with facts in a document called a prospectus. Lying in a prospectus became a federal crime. The goal was to level the playing field, giving investors the information they needed to make informed decisions rather than just betting on rumors. While the 1933 Act focused on the initial sale of securities, it didn't regulate the trading that happened afterward on stock exchanges. That's where the Securities Exchange Act of 1934 came in. This was the big one. It created the U.S. Securities and Exchange Commission, or the SEC. The SEC was established as the federal watchdog for the securities industry. Its mission was, and still is, to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC was given broad authority to regulate stock exchanges, brokers, and dealers. It outlawed fraudulent practices like price manipulation and insider trading, the practice of trading stocks based on confidential information not available to the public. The act also mandated that publicly traded companies file regular financial reports, like quarterly and annual reports, to keep investors continuously updated. In essence, the SEC became the cop on the beat for Wall Street. Before the SEC, the stock market was governed by its own private club rules. After 1934, it was subject to federal law, with a powerful agency dedicated to enforcing transparency and fairness. Joseph P. Kennedy, a known stock market player and father of future President John F. Kennedy, was ironically appointed as the first chairman of the SEC. Roosevelt's logic was, "It takes a thief to catch a thief." And Kennedy's inside knowledge of market manipulation actually made him effective at cleaning it up. Together, these three reforms, the Glass-Steagall Act, the creation of the FDIC, and the establishment of the SEC, formed the bedrock of American financial regulation for over half a century. They fundamentally changed the relationship between the government, the financial industry, and the American public. The goal was to replace the chaos of the 1920s with a system built on stability, trust, and transparency. These weren't anti-capitalist measures. Roosevelt and the New Dealers believed that for capitalism to work for everyone, it needed rules. It needed a referee to ensure a fair game. Of course, these laws weren't perfect, and they've evolved over time. Parts of the Glass-Steagall Act, for instance, were repealed in 1999, a move that some critics argue contributed to the 2008 financial crisis. But that's a story for another day. The core principles established during the New Deal, deposit insurance, the separation of risk, corporate transparency, and a federal regulator policing the markets, remain central to our financial system today. They are the invisible architecture that works to prevent another Great Depression. They were born from a crisis, but they provided a foundation of stability that allowed for decades of economic growth and prosperity. The next time you walk into a bank or check your investment account, remember the financial panic of the 1930s and the monumental efforts of the New Deal to build a safer, more trustworthy system for all of us. Thanks for watching, and if you found this interesting, be sure to like and subscribe for more deep dives into history. See you next time.